All right, in Chapter 3, we're going to look at the application of concepts relating to adjusting entries in these problems. So what I have up here on the left are the exercises, and on the right will be the solutions. So the first one we're going to work with is exercise 3-9. We are preparing adjusting entries for the following separate cases. Okay, we're doing this for the year ended December 31st. They have given us a list of some accounts that we will be using to prepare these adjusting entries. The first adjusting entry, wages of $8,000 are earned by workers but not paid as of December 31st. The whole point of adjusting entries at the end of an accounting period is to make sure that all transactions that occurred during this accounting period, and in this problem it's for the year ended December 31st, we are wanting to make sure that all entries, all transactions are recorded. So the first adjusting entry, there are wages of $8,000 that workers have earned, but they had not been paid as of December 31st. That means wages expense has been incurred, but it hasn't been recorded because we haven't paid. So we have an expense incurred but not paid. To record an expense that the company has incurred, we need to increase the wages expense, and we haven't paid it, so we're going to record a liability for that expense as well. So our adjusting entry is to increase our expenses with a debit and increase our liabilities, wages payable, with a credit. Okay. The second adjusting entry, depreciation on the company's equipment for the year, is $18,000. Depreciation is simply the expense incurred as we use our long-term assets to help us earn revenues. That means the company hasn't incurred an expense that hasn't been recorded. $18,000 worth of property, plant, and equipment was used. Okay. In this example, it was the equipment. We are going to be debiting depreciation expense for the $18,000. And long-term assets are the one type of asset that we don't directly decrease as we use their value to help us earn revenues. Instead, we use a contra asset account called accumulated depreciation. And this account will accumulate all of the depreciation expense we record over the asset's life. It is a contra asset account. It has a credit balance. To increase it, we will credit it. So we're debiting the expense, crediting the accumulated depreciation account. The third adjusting entries, the supply account has a current $240 debit balance at the beginning of the year. Then during the year, $5,200 of supplies were purchased. So those were added to that beginning debit balance, bringing the balance up to $5,440. But at the end of the year, a physical count shows that only $440 worth of supplies are currently available. So right now, if we look at the supply account in the general ledger, it started with a $240 balance, but that was increased when we purchased $5,200 during the year. So the balance in supplies is now $5,440. But when we counted our supplies, we discovered we only have $440 on hand and available. The asset is reporting $5,440, only $440 are available. The difference of $5,000 is the amount of supplies that were used during the year. And as we use up those supplies, our asset needs to be decreased. And as we use up the asset, we're incurring the expense of the supplies that were used. We're incurring our supplies expense. So our adjusting entry is going to debit supplies expense, increasing the expense account, crediting supplies. We're recording the amount of expense incurred, the asset decreased. In D, the prepaid insurance account had a $4,000 balance at the beginning of the year. So we started the year with $4,000 in prepaid insurance. an analysis of insurance policies shows that $1,200 of unexpired insurance benefits still remain at the end of the year. Our asset is reporting we have $4,000 worth of prepaid insurance. But when we analyzed it, we discovered we only have $1,200 of insurance unexpired or unused at the end of December. So that prepaid insurance asset account, when we prepaid our insurance cost, has decreased, or it needs to be decreased. Currently it shows $4,000. We only have $1,200 remaining. $2,800 worth of insurance was incurred. Insurance expense needs to be increased, and our prepaid insurance account needs to be decreased. Credit the asset to decrease it, debit the expense to increase it. In E, the company has earned but has not recorded $1,050 of interest revenue for the year ended December 31st. We are going to receive that interest payment sometime in January. But as of December 31st, we have a revenue that we have earned, but we hadn't recorded in the accounting system yet. So our adjusting entry will be to increase our revenues with a credit and increase our receivables. We have a revenue earned for which we have not been paid. So we will debit interest receivable, increasing that asset, credit the interest revenue to increase our recorded revenues for the year. In F, the company has a bank loan and has incurred but not recorded interest expense at $2,500 for the year ended December 31st. The company will pay that interest sometime in January. As of December 31st, we have interest expense incurred, we haven't recorded it, and we haven't paid it. So we need to record the expense of $2,500 and a liability. We will be paying that expense sometime next year. Increase the liability with a credit. Okay. Down here we can see visuals of the prepaid insurance adjustment as well as the supplies adjustment that you can reference if that would be beneficial to you. All right, we're going to move on to this next problem, which really is going to be a good cumulative problem to pull together some of the critical concepts and everything we've learned in chapters 1, 2, and 3. So we're going to work with this problem 3-3A. Wells Technical Institute. It is a school owned by Tristana Wells, provides trainings to people who pay tuition directly to the school. It does offer training to groups in offsite locations. They have provided to us their unadjusted trial balance for December 31st. Right? So remember what a trial balance is. It is a list of all the accounts that they have in their general ledger, along with their balances at the end of the year. Okay, here the end of the accounting period is December 31st. It is called the unadjusted trial balance because all of these balances are in the general ledger before any adjusting entries have been posted. So this is where we left off in the last chapter. These are the accounts balances after all the normal day-to-day transactions were recorded throughout this year. Okay. What they have given us over here in the problem information is some additional information about adjustments that need to be made to these account balances to ensure that everything that was recorded during the period has been recorded. What we're going to do in this problem is we are going to prepare the adjusting entries and then post them into the accounts in the general ledger. So what the problem is going to ask us to do first is to prepare T accounts that represent the general ledger with balances from the unadjusted trial balance. So I'm pulling up over here on the right all of the accounts that are listed in the unadjusted trial balance. And what we're going to do is we're going to enter their balances. For example, here is the cash account represented in a T form. this is the balance that was in the account prior to adjustments being made. So this is the unadjusted balance. It is a debit balance because it is an asset account. Accounts receivable has an unadjusted balance of 0. Teaching supplies has an unadjusted balance of $8,000. Prepaid insurance has an unadjusted balance of $12,000. Okay, so all I'm doing in this first step is just entering the balances that are listed before adjustments were made. All the balances from the unadjusted trial balance. Then the next thing that the problem wants to do is to prepare the adjusting journal entries for these items, and then we will go back to those trial balance, or excuse me, to those general ledger T accounts, and we will post the adjustments. Okay. So the first thing we're going to do is they've analyzed their insurance policies, and they show that $2,400 of coverage has expired. Okay. So what do they mean here? What they mean is, sorry, I'm going the wrong way, that right now, if we look at the prepaid insurance account, the unadjusted balance is $12,000. That was the balance that was reported in the unadjusted trial balance for prepaid insurance. But they have analyzed it and only $2,400 of coverage has expired. So they no longer have $12,000 of prepaid insurance. $2,400 of it has expired. So what we need to do is prepare an adjusting entry to adjust the prepaid insurance to reflect the amount that they actually have. So we need to decrease prepaid insurance $2,400. And we use that asset to help us cover our insurance costs. So we are going to debit the insurance expense account. Here's our adjusting entry. We are going to be recording the expense incurred during the accounting period for insurance. Don't have to pay it because we had prepaid it, but we're using up that prepaid insurance asset account to cover that insurance cost. The second adjustment, we did an inventory count, and it shows that the teaching supplies of $2,800 are still available at year end. If I look right now at the balance in the teaching supplies account, and there's $8,000 balance recorded in that account. So right now the asset has a balance of $8,000, but only $2,800 are available at year end. Hey, what that is telling me is that if I were to look at the teaching supplies account, and it has a balance right now of $8,000, but only $2,800 are available, I want my balance in this account to be $2,800 to reflect what it is that I actually have, right? So my adjusting entry needs to decrease this account from a balance of $8,000 down to a balance of $2,800. So the difference, the amount I need to decrease that account, is $5,200. So my adjusting entry is going to be to credit the teaching supplies account for $5,200, and I used up those supplies. I incurred an expense. So I'm debiting the expense, crediting the supplies. All right, annual depreciation on the equipment is $13,200, and on the library is $7,200. Remember, when we use up long-term assets and they become an expense, we are not going to directly adjust the asset account. Unlike the first two, these current assets, as we use them up, we decrease the asset and recorded the expense. But when we're dealing with property, plant, and equipment, we are not going to directly adjust the asset account. We're going to record the expense, the cost of the asset that was used to help us earn our revenues, but we're going to use the accumulated depreciation account, the contra asset account, to keep track of how much of the asset's cost was used. So our adjusting entry for both of these long-term assets is to debit depreciation expense and credit the accumulated depreciation on each of those assets. Okay, it's a little bit strange and a little bit weird, but we're going to spend an entire chapter talking about this concept of depreciation in the future. For now, the reason we're learning about it in this chapter is because it's part of the adjusting process. It needs to be done at the end of the accounting period. Okay. All right, the next adjusting entry on September 1st, the company agreed to do 5 training courses for a client at $2,500 each. So back at that time when the client paid them in advance for something they have not done, they did not record a revenue at that time. They recorded an unearned revenue. Okay. So if I were to look at their trial balance, I would see they have an unearned revenue in their general ledger of $12,500. That is a liability. Okay. 5 training courses at $2,500 each. They recorded a liability of $12,500 when the customers prepaid them. They couldn't record the revenue at that time. At that time, they increased their cash and increased their liability. Because remember, we do not record revenues until we provide the service and have earned them. So there's a liability sitting in the general ledger right now of $12,500. By the end of the year, all 5 training courses, I got to read this carefully. 3 courses will not begin until next year. But remember, the client paid cash in advance for all 5 training courses in September. This is telling me that out of the 5 that the client prepaid, 3 of them have not been provided, so we haven't earned 3 out of those 5 courses. But we did provide 2 of the courses that the customer prepaid for. So if the customer prepaid $2,500 per course and we have provided 2 of them, we have paid off $5,000 of that liability by providing the service, which means the liability needs to decrease $5,000. So we are going to decrease the unearned revenue account because we've paid off that liability, and we paid it off by providing the service, which means we have earned a revenue. So we are going to increase our training revenue account. Debit the liability to decrease it, credit the revenue account to increase it. Okay. All right, adjustment F. On October 15th, we agreed to teach a 4-month class for an executive with payment due at the end of the class. At December 31st, so get rid of that thing. At December 31st, $7,500 of tuition revenue has been earned by WTI. All right, so we are providing a service to a customer. The customer hasn't paid us. We have earned $7,500 of tuition. We haven't been paid. Record a revenue earned for which we have not received payment. We are going to debit the accounts receivable because the customer owes us, and we are going to credit the revenue because we have earned the revenue. In G, WTI's 2 employees are paid weekly. As of the end of the year, 2 days' salaries have accrued at the rate of $100 per day for each employee. Accrued is just a fancy accounting term to mean accumulated. 2 days' salaries, 2 employees, 2 days, $100 per day, $400. $400 of salaries expense has accumulated, but we haven't paid yet. We are going to record it in expense incurred, but not paid. We are going to debit salaries expense, increasing the expense to record the expense incurred, and credit the liability. Record the liability incurred because we haven't paid our expense. Debit salaries expense, credit salaries payable. 2 days, $100 per day for 2 employees. All right, finally, The balance in prepaid rent represents the rent for December. All right, what balance are they talking about? Now down here, oh, there's prepaid rent. There's a balance there. That prepaid rent was recorded when we paid in advance for December rent. It is now the end of December, which means we no longer have this asset for prepaid rent. We have used it to cover our rent expense for the month. That balance needs to decrease because we have used up that $3,000 asset to cover our rent expense for the month. Decrease prepaid rent with a credit and record the rent expense incurred. Increase our expense with the debit, credit prepaid rent, the asset to decrease it. Okay. So what we have done is we have analyzed all the accounts and prepared adjusting entries for all of the things, all of the accounts that need to be adjusted to ensure that everything that happened during this period is recorded during this period. So in order to now cause the account balances to update, we need to post these. So I'm going to take each debit and credit from the general journal and post it into the ledger. So I'm going to debit insurance expense for $2,400. So going back up here, let me find my insurance expense. And there it is. Prior to my adjusting entries, the balance in insurance expense was 0. By posting my debit, my adjusting entry, I have caused the adjusted balance to increase to $2,400. I have now recorded my insurance expense for the year. I then need to credit prepaid insurance. So I'm going to find my prepaid insurance. And where is it? There it is. Prior to adjustments, its balance was $12,000. Crediting at $2,400, I have adjusted the balance down to $9,600. My next adjustment is to debit teaching supplies expense, credit teaching supplies. So I'm going to find my teaching supply expense. Prior to adjustment, its balance was 0. Debiting at $5,200, I've increased its balance to $5,200. And my teaching supplies prior to adjustment had a balance of $8,000 as reflected in my unadjusted trial balance. Credited at $5,200, bringing its balance down to $2,800. It is now adjusted. Adjustment C and D, I'll do at the same time. I'm going to debit these depreciation expense accounts and credit the accumulated depreciation accounts. So here are my two depreciation accounts, which had 0 unadjusted balances as reflected in the unadjusted trial balance. Debiting them, I'm increasing their balance to get to the adjusted balance. I then need to debit unearned revenue and credit training revenue for my next adjustment. So I'm going to find my unearned revenue here. There it is. Unadjusted, it was $12,500 as reflected in the unadjusted trial balance. I'm adjusting it, decreasing it $5,000 to get an adjusted balance of $7,500. And then I'm going to record my tuition revenue, increasing it, adjusting its balance to $131,400. Right. I'm sorry, that should have been training revenue. I apologize, those on the wrong revenue account. Then the next one is the tuition revenue. I need to debit my accounts receivable, credit tuition revenue. Okay, so where is my receivables? There it is. I had no receivable. My unadjusted balance was 0, but I'm increasing it $7,500, adjusting its balance to $7,500. And then I'm going to credit my Where did it go? My revenue account, up, down more. There's my tuition revenue. I'm going to adjust it. Okay. So what I'm doing is I'm just posting these into the general ledger to cause these account balances to actually change. So do the same thing with salaries expense and salaries payable. I am posting if I can find the salaries expense, there it is. I'm adjusting it, increasing it 400 and increasing my salaries payable 400, adjusting that balance to reflect what we actually owe at the end of the year. And my last adjustment is to record the prepaid rent that was used and record my rent expense. So here I am increasing my rent expense balance, so it is adjusted. And my prepaid rent is now adjusted down to 0, decreasing it. We no longer have any prepaid rent. Okay. So what I have done is after I prepared the adjusting entries in the general journal, I have posted them into the general ledger. And we don't have any post reference columns here to notate that we posted them, but we know we did. And now what I'm seeing in the general ledger is all of these adjusted balances in all my accounts. Okay. What that means is I have now ensured that everything that happened during the year that should be recorded in these accounts has been. So in order to make sure that I am still in balance, I'm going to now prepare an adjusted trial balance after I did the posting. So just like the last trial balance, the unadjusted trial balance is just simply a list of all the account balances in the general ledger. So what I'm doing is I'm taking my balances right out of my general ledger and I'm going to put them into my unadjusted trial balance. Okay. Put the debit balances in the debit column, the credit balances in the credit column. Okay. And all this is kind of big to get into one page, so it's kind of split here, so I'm scrolling. But if I total up the debit balances and then total up all the credit balances, I hope that they agree. Right? That just simply means that my accounting system is in balance. It does not mean that I did not make any errors. Okay, I could have still made a few errors. All right. So the very last thing we're going to do now is prepare the income statement, statement of owner's equity, and the balance sheet. Okay, we're going to assume that the capital account balance started the year, end of last year, prior year becomes this year's beginning capital balance. There were no owner investments in the current year. Okay, so what we're seeing is that in the capital account, this balance of $90,000 in my unadjusted trial balance, or excuse me, my adjusted trial balance is the same beginning balance. So nothing affected this account during the year. Okay, so now to prepare my income statement, I'm going to report the revenues earned during the year for my adjusted balances and all my expenses. So here is my income statement. Again, it's for a period of time reporting revenues and expenses for the year ended December 31st. Here is my revenue section, listing my revenues, total revenues, my expenses subtitle, all my expenses totaling $126,800. Total revenues exceeded total expenses, leaving me with the net income. Now that I have my net income, I can prepare my statement of owner's equity. The statement of owner's equity is going to show the beginning balance in capital. Remember, last year's ending became this year's beginning, along with any withdrawals and other impacts on equity, which is our revenues and expenses. But instead of re-summarizing all my revenues and expenses again, I'm just going to use my net income from my income statement to prepare my statement of owner's equity. Began the year with $90,000. Remember, they told us that we ended last year with 90. Nothing changed it during the year. There were no owner investments. So we have no investments to add. Net income from my income statement was $49,600, increasing equity for the year, get a subtotal, and then I'm going to subtract out my owner withdrawals. which during the year we had 50,000 of owner withdrawals, leaving me with ending owner's capital of 89.6. We have now reported profits. We have now reported the change of equity for the owner. Let's prepare a balance sheet to report the overall financial position. So we need all of the assets, we need the liabilities, and then we're going to use ending owner's capital from the owner's equity statement to prepare our balance sheet. Remember, the date on a balance sheet is different from the other two reports. It is one day in time, a snapshot, a screenshot, a picture on the last day of this year, December 31st. These were the assets, these were the liabilities, and the ending equity. Remember, that equity amount came straight from our owner's statement of owner's equity. Okay. One thing I want to point out here that is a little bit different in this chapter is that accumulated depreciation account. Okay. Remember, generally accepted accounting principle want us to report long-term assets at their original cost. So this is the amount we recorded in the asset account. That's what we paid for when we bought it. Then the accumulated depreciation account is keeping track of all the depreciation expense we recorded since we bought that asset. So the difference between the account balance, the asset's original cost, less its contra asset account, its accumulated depreciation, is what we call the asset's book value. As of December 31st, this asset still has unused value of $17,800. $17,200 of that asset's original value has been used and depreciated, recorded as an expense. Equipment was originally bought for $80,000. Since we bought it, we have expensed $28,200 of it, leaving it with a remaining value as of December 31st of this year of $51,800. Okay. So contra asset accounts offset the account they're tied to. Okay. All right, hopefully that helps. Essentially what we have done in that last problem is we looked at our unadjusted trial balance, we adjusted it to the point where we were ready to prepare financial reports. Okay. And so now we've got the financial reports prepared. We're ready to do the final steps of the accounting cycle, which we will learn in the next chapter, closing the books.